Presentations will be start in 3, 2, 1. An investment market by global uncertainty and rapid economic shift, making the right investment decisions requires more than intuitions. It requires insight, discipline, and a clear strategy. Welcome to the investment report of JP Morgan. Next, please. In our company, we have 5 analysts, which is Az-Zahra, Fadgam Ghani, Muhammad Yasin, Yuki Chogofaran, and Nelson Arya Suredi. Next. Here we have our company profile. Founded in 2025, JP Morgan was established on the convictions that a truly successful financial journey is defined by more than just numbers on a spreadsheet. We are a firm dedicated to the relentless pursuit of growth, not merely in capital but in knowledge and resilience of our client gain and the long-term value we create together. Next. Before we dive deeper into our detailed report, here we have executive summary, which is a JP Morgan is an actively managed Indonesian equity strategy able to monetize catalyst events and sector rotations across the IDX. The process combines top-down regime awareness with bottom-up stock selections, using liquidity in order flow as confirmations to improve timing and reduce fall catalyst entries. Next. Here we have investment objective. We have we have categorized our investment into structured 3 tiers. The first is defensive core, consists of 50% in large cap and state-owned enterprise to answer capital preservations and stable income. The second is core growth, it consists of 30%, targeting long-term value creations from digitalizations and infrastructure development. And the third is speculative growth, consists of 20% to capture high return tactical opportunities. Next.
Okay, for the investment strategy, the strategy is designed as an active and dynamic approach, meaning that the portfolio doesn't rely on the passive buy and hold method. Instead, the allocation are adjusted tactically in response to the market movement and changing opportunities. For an execution perspective, the portfolio operates with a medium-term investment horizon, typically over several weeks, which allow the strategy to benefit from momentum and sector level trends. By doing this, we're also avoiding the excessive trading frequency. Sector rotation also play an important role here, as the capital is reallocated across sectors with stronger fundamental or market sentiment. In terms of risk management, the portfolio emphasizes diversified exposure, discipline, position sizing. Next.
Okay, so our strategy starts with a top-down read of the market regime to identify where risk-adjusted opportunities are most attractive. Then narrows into bottom-up stock selection. We allocate using a risk pyramid, a defensive liquid core as the base, a growth sleeve for structural themes, and a smaller high-conviction tactical sleeve for special situations and momentum. Positions are actively rotated based on shifts in catalyst and technical strength, with predefined sizing and exit rules to control drawdowns while preserving upside when the thesis plays out. Next. So for our screening strategies, JP Morgan's screen stocks through four practical pillars, which are policy catalyst, earning catalyst, macro tailwinds, and liquidity rotation supported by order flow. To track performance consistently, we used a unitized NAV framework where NAV per unit equals fund assets minus liabilities divided by units outstanding. With 5 million initial capital, 0 liabilities, and 1,000 units, the starting NAV is 5,000 rupees per unit. This structure keeps returns comparable across weeks and makes portfolio changes transparent. Next.
Okay, now we're gonna head on into our weekly asset allocation and rotation. Our portfolio was divided into 3 main phases. The first phase was aggressive during weeks 1 to 3. We built a core position in banking stocks like BBRE and BMRE, while taking higher risk in technology stocks such as CDR and Wi-Fi. However, when CDR dropped significantly as of negative to 25%, we quickly cut our losses to protect our capital. Phase 2 was a defensive rebalancing from weeks 4 to 7. After high volatility, we rotated back to defensive stocks, mainly banks. At the same time, we started accumulating BBRM from the logistics sector at low prices, and we sold underperforming mining stocks like PSIB and Inco. And the last phase was our tactical wins from weeks 8 to 11. Here, we focus on short-term momentum and special situation. This phase gave us a strong gains, especially from ARCO and later BBRM. Next. Here you can see our weekly allocation and rotation chart. The chart show our portfolio composition from week 1 all the way to week 11. The cyan block, which is BBRE at the bottom, and the yellow block, BBMRE at the top, are our core assets. They stayed relatively stable and acted as our safety layer for the portfolio. The color in the middle represent our active trading position, such as technology, energy, and logistics stocks. For example, in week 8, you can see a new purple block, which is represented as ARCO, our most successful trade. The large maroon blocks shows our cash position. We intentionally keep a high cash balance so we could react quickly when opportunities appeared. By week 11, the total bar is the tallest, which is show that our strategy successfully increased total portfolio value. Next. Now we can see our performance analysis. Our performance compared to our three benchmark, which is the local benchmark, regional benchmark, and global benchmark. As you can see here, our final return was a plus 8.78%. We managed to outperform the LQ45 and the S&P 500, but we still underperformed compared to the Nikkei 225. The journey was very volatile. We reached a peak return of almost 80% in week 3, but a sharp correction in week 4 reduced our gain significantly. This shows how difficult it is to maintain aggressive strategies over time. Next. And this is our weekly returns chart. As you can see, the chart shows that our portfolio experienced much higher volatility than the benchmark, with strong gains in week 3, followed immediately by a large drop in week 4, and another dip happened in week 9. Even though volatility did not lead to a massive final spike, our early aggressive strategy still helped us in the end period with a positive return. Next. This next chart is basically the same as the previous chart. The difference is just the cumulative return. So we can go to the next slide.
So in the market of uncertainty, the true test of a portfolio is its ability to remain productive and also efficient. Our result today proved that JP Morgan is not only resilient but also globally competitive, significantly outperforming major international benchmark in risk-adjusted efficiency. So let's look at our trend ratio, where we measure our return per unit of market risk, or we called it beta. JP Morgan's achieved a ratio of 0.0025. Again, we see our portfolio strength is outperforming the S&P 500 benchmark of 0.0021. This is a critical indicator of our tactical success. It shows that for every increment of market-driven risk we assume, we extracted more value than the broader US market. We didn't overextend ourselves. Instead, we calibrated our systematic exposure to ensure that we capture market premiums without falling victim to erratic swings. We have effectively navigated the systemic landscape better than the global average. Next is a Sharpe ratio of 0.0576. While this may look conservative next to regional indices, the real story is in the comparison with the global stage. We outperformed the S&P 500, which sits at the marginal of 0.0063 by nearly 9 times. And what does this tell us? It proves that JP Morgan is vastly more efficient at converting total volatility into profit than one of the world's most prominent indices. We are not just taking risks, we are managing them. This positive ratio confirms that our strategy prioritized capital productivity, ensuring that every unit of risk taken was compensated with a steady and also reliable turn. Finally, looking at the Janssen Alpha, we recorded a result minus 0.0048. In the world of professional fund management, we call this as a near market parity with only a marginal of 0.48% deviation from the CPM expectation. This result proved that our portfolio is exceptionally well aligned with the market risk profile. We successfully avoided uncompensated speculative risk and maintaining a defensive and also stable posture. And this wasn't about luck, it was about structural consistency. We have built a robust foundation that tracks the market trajectory with high precision, ensuring stability for our investors.
Okay, to evaluate the portfolio performance, we compare the initial NAV with the ending NAV. As stated before, that the initial NAV is 5,000 per unit, and at the end of the investment period, the total asset increased to 5,390,000, which conclude that the NAV is 5,390 per unit. This represents an increase of approximately 7.83%. Therefore, this increase of NAV confirms that the investment strategy successfully achieved capital appreciations over the investment period. I think that's all from us. Thank you.